Wednesday, May 27th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Wow, it was a crazy day yesterday on Wall Street. Things got flipped upside down. We've talked about that in the past, where we've had some days where everything seemed to be reversed from what we saw over the course of the past few months. A lot of the stocks that were benefiting from the pandemic over the past couple of months, and even those that have showed really strong earnings growth and so forth, they were kind of shunned in the market yesterday. Saw a lot of rotation, but I do see good news in that. And the good news is that the market didn't go down with those leaders falling. Instead, the money simply rotated over into some of the areas where the market had been much weaker. So that, I think, was very good news for the market, that we were able to see that kind of rotation rather than money simply coming out of the market. So we're going to get into all that in just a minute. For those of you that are new to Earnings Beats, welcome. Obviously, welcome to all of our regulars. I do want to just point out that if you go over to Earnings Beats, if you're not already an Earnings Beats Digest member, subscriber, it's free. So just type in your name and email address, hit the subscribe button there, and you'll be good to go. Monday, Wednesday, Friday, we'll make sure you get a very brief article. Normally, I'm just talking about one stock. Could be an index, but usually it's a stock that's either getting ready to report earnings, has already reported earnings, maybe showing relative strength. Accumulation distribution is something that we've paid a lot of attention to the last couple of months, although I'll be honest, I think as we go forward here, it's not going to be as important. I think it gave us a great hint, some great hints, some great clues off of that February high as the market was coming down. We saw money, really rotating after the open. And in some ways, we're seeing the exact opposite right now. So what we were seeing back in late February, and especially in the month of March, we'd see gap downs on all stocks. And then from the opening bell to the closing bell, there was a big divergence. A lot of stocks were being accumulated, a lot of others were not, and they were being distributed. And that was showing up in the AD lines. Really what we've seen a little bit more of recently, and definitely yesterday, was every stock or most stocks gapping up. And then from the opening bell to the closing bell, we saw the opposite, where money was actually, you saw money being, or money rotating out of areas that have been leading the market. A lot of software stocks got hit throughout the day yesterday, just kept selling off. Many of the pandemic-related stocks that would benefit from folks being at home, Peloton, and some of those types of stocks were being sold throughout the day. Zoom was another one, Teladoc, TDOC, many of the biotechs, Moderna, mRNA, even Novavax, NVAX came out yesterday morning and announced that they were starting phase 2 trials and that they would have results in July on a vaccine that they're working on. And after a big gap up, at one point yesterday in pre-market, I saw NVAX was up like $11 from 47 to 58. And I think the stock finished at 49. Once it opened, they were selling throughout the day. So anything related to COVID-19 and the perceived benefits of this paradigm shift, any of those companies, after opening fairly strong, or at least not bad yesterday, many of them sold off during the day. And that money, instead of the market going down 1,000 points on the Dow and so forth, we actually went higher because that money and more was rotating into some of the areas that have been beaten up. So the whole thought process here, if you follow the stock market tells a story. And if you're willing to kind of open the book and do a little research and maybe read a few chapters, it starts to make sense as to what the market's doing. Now, trying to stay one chapter ahead of the market is not an easy thing to do. But as best we can do that, it will help us in the market. And so I don't know if this is a rotational shift that's going to take place for a couple of days, whether this is a major move back and, all of a sudden we're going to forget about what happened with the virus. I have a feeling that's not going to happen. I think that there have been some real changes, and I think there are going to be real changes going forward. I don't believe everyone's just going to rush back to the airports and to cruise lines. Yet, looking at the charts of airlines and cruise lines yesterday and some of the pre-market action in some of those stocks today, you would think that everybody's booking flights and trips, some kind of a cruise. I don't think that's going to happen. So I think that this is going to be more of a shorter term. But many of these stocks are starting to look better technically. And what that means is that a lot of folks that have been shorting and betting against these companies are going to have to cover. And when they have to cover, that means they have to buy back their borrowed shares. So if you're shorting stocks, what you're doing is you're borrowing shares from your broker, and then you're selling them in hopes that the stock's going to go down, and then you can buy them back cheaper, and then you return the shares. That's how shorting works. So the idea is you're going to sell somebody else's shares. You're going to borrow them, and you're going to sell them when they're high. You're going to buy them back when they're lower. You're going to profit on the difference, and nobody's going to know the difference because, you're just borrowing shares. You're borrowing shares you never owned in the first place. That'll work in the short term. That's not going to be a long-term fix for these companies. So I think that short term, yes, we could continue to see this. It's hard to say how long it will go, but I do believe some of these companies that have been very strong and are seeing a pullback, which is normal in any market. You get these stocks that go up a lot, and they're going to pull back. And those that bought at the top are going to panic out. Market makers are going to be able to accumulate shares as we move lower. And then they're going to be able to sell those shares to institutions at better prices. That's how market makers keep their institutions happy, because they use the emotional side of trading to accumulate shares. Folks that aren't paying attention or don't realize what's going on in terms of market making action and the way the market works. Market's very inefficient short term. It's very efficient long term. So eventually, if a stock's making good money, it's going to go higher. If the price or if the earnings are growing and the outlook is good and they continue to do well in their business, their stock price is going to go up. Look at Apple. I mean, Apple is a perfect example. Now, we can't all find companies like Apple every day, but there are a lot of good companies out there. And there are going to be a lot of really good companies created out of this pandemic. I believe that. And so some of these pullbacks are going to be opportunities to get in. Looking at the action yesterday, let's get into some of the specific action here. You can see the Dow Jones failed to get through 25,000. Intraday, we were over 25,000, came back, closed just below it. Today, futures, last time I looked, over 350 points higher on the Dow. So 25,000 is going to be a thing of the past at the opening bell. I'm really happy to see the Dow and the S&P. I mean, I've got stocks that didn't really benefit yesterday, and some of them came down. But aside from that, I like what's happening in the market. I've said, pretty much throughout this pandemic that I believe we remain in a secular bull market because of that big picture that we went into this pandemic with. And so as we pulled back, yes, it was scary. But when we started seeing that accumulation distribution line, the way the money was rotating around, it gave us a lot of hope that there were going to be companies that were going to help lead us out of this mess. They did. And now we're seeing the rest of the stocks begin to follow suit to the upside. And I think that's very encouraging. So there you can see the Dow breaking above recent highs, S&P above recent highs. NASDAQ, it wasn't nearly as impressive. If you look at the percentage gains, the Dow was up more than 2%. The S&P 1.25%. And the NASDAQ, if we'd been open another 15 minutes, probably would have been red. I know the NASDAQ 100 went red. Mid caps did well, small caps did well. These are areas that had been struggling, but look at the breakouts here on the mid caps and small caps. This can't be viewed bearishly, I don't think, by anyone. I mean, we're getting more and more breakouts. More and more companies are looking bullish on their charts. And so if you're looking at the market as, as a buyer or a seller, technically, you're seeing a lot more charts that are looking bullish that you'd want to buy as opposed to bearish that you think, you'd want to sell. And I would continue to watch the rising 20-day moving average. And now the 50-day moving average is starting to rise. Normally, we don't see strength in a bear market. We don't see strength last long enough to turn that 50-day moving average to the upside. This would be a very, very kind of a rare bear market rally if that's all this turns out to be. I'd be shocked. I do not believe that at all. I think the market's going to new all-time highs. When we first started doing this, it was like, started moving back to the upside. I figured we'd go to all-time highs, but I didn't know if it would be later this year or next year. But I got to say, the way the market is reacting right now, there's not much question in my mind this year we're going to be at an all-time high again. And it may not be that far away. The NASDAQ's not far already. The S&P 500 went over 3,000 yesterday, came back below, but is looking to open above 3,000 again today. The high was up just shy of 3,400. I mean, we've now come up over 800 points off of the bottom. We only need another 400 to go to get there. So that's half of what we've seen just over the past 2 months. So I think the market is beginning to feel like that the virus is not going to last, which I think we all knew that from the beginning. The question was how much destruction would it do in the short term? And there's no doubt that's done a lot of damage. I mean, you can't shut down an entire country for several weeks and not see economic impact. But I think when you look at what the government has done in terms of these stimulus packages, and you look at what the Federal Reserve has done and what government and the Fed are both ready to do if necessary, I think that they've done a good job in trying to bridge this 2 or 3 month period until we can begin to open back up again. There's still the threat. Okay, what happens in the fall? What happens in a couple weeks, few weeks, if cases start to rise? Well, President Trump's come out and said, we're not shutting down the country. I don't know how everything's going to fall out, but what I do know and what I tend to follow are the charts. I don't follow the media. I don't follow, this person saying this or that person saying this or the Democrats versus the Republicans. I don't get into any of that. I could care less, to be honest. I follow what's going on in the charts. Charts tell me everything I need to know. It factors all of that in. If you take a look at the stock market and you say to yourself, well, I'm going to get into this stock because of this reason. Well, if that reason is a public reason, if people know about that reason, it's been factored in. You're trying to come up with something that the market doesn't know. Good luck. I mean, the market knows just about everything. It has knowledge. And so these prices and what we're seeing in terms of trends and the breakouts are based on all of this knowledge that the market has, and then it's going out and it's doing its thing. So I like what's going on. Now, I said the market was flipped upside down. Look at the leaders in terms of sectors. Financials up 5%, industrials 4%, energy 3%, real estate 3%, energy 2.75%, same with materials 2.75%. I mean, these 5 groups are essentially the 5 worst groups in the market. So everything got flipped. We had mid caps and small caps leading. We had the Dow beating the S&P, which beat the NASDAQ. 5 sectors that have been underperformers leading. It's been, it really was the stock market turned upside down. And I think in the short term, we could see that continue for a bit. Again, I'm not giving up on those other companies. I think there's a lot of companies that are going to benefit long-term from a paradigm shift. I mean, here in South Carolina where I am, we've opened up, and I've been out more. But when I go out, if I go to a restaurant, I want to sit outside. I don't want to sit inside. If I do happen to sit inside, I want to make sure that I'm still very far apart from everyone else. Just about everything I do, our business fortunately was already in a position where we do a lot of online collaboration. But I think there are a lot of other businesses that aren't normally like that have seen the efficiencies and the benefits and the fact that many of their employees like working from home. That is going to change a lot of the way a lot of businesses do business. So there are definitely going to be changes going forward as a result of this virus. All right, let's keep moving on. Got a bunch of things I want to get through here. 10-year Treasury yield today. Let's get an update here. You can see right now is at 0.71%. So it's up about a basis point or so. And this is kind of the exciting part of the market too. I mean, a lot of money has rotated into treasuries the last few months. if all of a sudden things are starting to get better in terms of opening up our economy, there is a ton of money still available to come into the market from an overbought bond market. We're seeing right now money coming off the sidelines maybe a little bit. We're seeing rotation between stocks so that when the Pelotons of the world sell off for a period of time, the market's not going down. That money is simply being reinvested somewhere else in the stock market. That's a good sign. We don't want money coming out of the market. The good news is we have not seen all of the billions of dollars that have poured into the Treasury market make its way out of the Treasury market and corporate bonds and so forth and back into the stock market. So this rally that we've seen still has not benefited from money rotating from bonds. Think about that for a minute. I mean, if our economy starts picking back up again and folks say, hey, you know what? Things are looking much better. I think I want to change my portfolio around a little bit, maybe a little less bonds, a little more stocks. Well, just a subtle change like that would likely result in a huge rally in the S&P 500. I think that's what's going to happen eventually. I think we're going to begin to see bonds start to turn back high, bonds start to turn lower and yields start to rise. And when that happens, I think we're really going to see quite a stock market going forward. And think about this, if the economy reopens and companies begin, we've already seen a number of companies showing great earnings, software companies, but if other companies begin to grow their earnings in a historically low interest rate environment, those earnings are worth a ton. And I cannot understand portfolio managers sitting back and holding bonds yielding 0.7% when they can buy cheap earnings that are growing rapidly. So I think there's going to be a rush out of bonds personally, some point. I can't tell you if it's going to be in 2 months, 6 months, or a year or two, but I think there's going to be, and I think that's part of this secular bull market that I've been talking about. I think that is going to fuel a massive rally in equities over the course of the next several years. I think this is just getting started personally. I think we're in, as I mentioned, even before the pandemic, I said we were in about the third or fourth inning. I think the last 2 or 3 months was a rain delay. I think after this, we go higher. I think the market continues to go higher. Very, very low interest rates. I think we had a strong economy before the pandemic. I think we're going to see it strengthen. I don't know how long it'll take us to get back to where we were. But I think we've already seen it in some areas of the market. The technology areas, the healthcare areas. And those stocks didn't benefit yesterday. I mean, they definitely went down. I think it's a short-term rotation. Those stocks have been outperforming for definitely the last few months, but really the last few years. They're entitled to take a break from time to time. All right, let's take a look at some of the areas of the market. So these are groups, for the most part, that have begun to look a lot better to me. So you got broadcasting and entertainment. Think Disney. Disney came out after the bell yesterday and they said that they're going to put together a proposal. They're going to be announcing it today. They're submitting a proposal for a phased reopening of their Florida parks. I think that their price, Disney's price, a lot of it was based on the fact that this virus was going to have a major impact for a long time. There was a lot of uncertainty over what, Disney might do. Well, when you start coming out with plans for reopening, that kind of changes the landscape a little bit for Disney and for many of these broadcasting and entertainment companies. And so you can see the market's been anticipating that. And I suspect that this is a group that will continue to rally. Follow that rising 20-day moving average. Follow that PPO. If this stays positive and we continue to hold a rising 20-day, we're in an uptrend. It's that simple. You can sit back and, I think if you're bearish, I think you're letting your predetermined bias of being bearish dictate what's going on. Because if you look at the charts, I think it's really hard to paint a bearish picture on what's taking place right now. So you've got stocks or areas of the market like broadcasting and entertainment that are looking better. Now, I want to show you the internet group because the internets have been on fire. But look at that reversing candle right there at a key area, 2150. We had not been able to close above. Yesterday, we opened at 2187, and this is what I was talking about. It opened higher, just like the overall market, but then we sold off all day long in the internet area. So there was rotation taking place, and the volume wasn't light. So I would expect that this is probably the start of some unwinding of some stocks in these areas. If you're a short-term trader, I think you got to be aware of that. If you're longer term and you're thinking, well, how does this impact 3 months, 6 months, 12 months from now? I'd say it really doesn't. But short term, yeah, I mean, that is off of a major uptrend at a major resistance level. When you get a reversal like that, I think you have to be aware of it, and what that could mean short term. So I suspect that we're going to have a pullback here. Now, whether or not we go all the way to the 20-day moving average, I'm not sure. But internet stocks, to me, great area of the market. I'm not changing my tune at all, longer term or even intermediate term. Short term, yeah, I wouldn't be surprised if we saw some more selling and more rotation. You're going to see some folks having to cover shorts in some of these other areas that they've been shorting heavily. But the good news is if it does pull back, I think you're going to be able to get internet stocks, software stocks, some of these pandemic-related stocks, like I mentioned, Peloton. I think some of those coming back, you're going to get some pretty good deals on those. All right, we mentioned the cruise lines. Well, they're part of the recreational services. So look at this chart. Double top right at about 65, 66. Yesterday we closed at 67. Volume was stronger. PPO's positive, pointing straight up. It's going up. That means momentum is building to the upside. Lots of shorts. You got technical buyers. You got shorts covering. I'd be shocked if we don't continue to see more strength near term in something like recreational services. How far it goes, I'm looking at the chart. I mean, I think you might see a little resistance around 75, but really I think it's got a shot to run maybe as high as into the 90s. And with shorts covering, would I be more nervous owning these stocks? Yeah, because I don't believe in their longer term or more intermediate term. I think it's going to be a while before people in masses start looking for cruise lines, cruises around the world. I think it's just going to be a slow process, but the landscape's a lot better than it was a week or a month or 2 months ago. There's no doubt about that. How about clothing and accessories? I mentioned this one in the DMR that I sent out to members a couple days ago. Here it was coming up, getting ready to make this breakout. Well, it's made it. And so you got, clothing and accessory stocks just on fire right now to the upside. So anyone shorting that area, they're just watching their money wilt away until they cover. So that's, again, why I think these stocks could continue to move higher. A lot of folks betting against them. And as we're getting these breakouts, they're having to either double down, which can be really painful if it continues going higher, or they're having to cover and just, stop the pain. Then we've got hotels. Hotels gapped up yesterday, pulled back, but we made the breakout. I expect hotels are going to continue to do well. I mean, if we get back down in the mid 1500s, gap support, this area where we just broke out from, I think you'd get some really good deals. One of the stocks I mentioned yesterday in this group, actually, no, I think it was more of a gambling stock I mentioned. But we talked about the gambling stocks. Watch Wynn. Big resistance area around 90, and this is a heavily shorted stock. I think if we get a breakout above 90, Wynn could really start to get the wind behind its back. Let's go ahead and move on. So I talked about rotation. So let me just show you a couple things with rotation. I want to go back. Let's look at I want to pull up the S&P 500 components. And I want to show you in summary form. Let's first look at the last 3 months, because that's about when this started, 3 months ago. Now, if you look 3 months ago, we do have a financial leading, but that's kind of an oddball. Look at what's been leading the last 3 months. Healthcare, technology, 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 healthcare, healthcare, technology. Discretionary, healthcare, technology, discretionary. We got a few thrown in there, financial here, energy here, staples here, but you can see it's mostly healthcare and technology with some consumer discretionary stocks. Those are the leaders last 3 months. The losers: industrial, staples, energy, industrial real estate, industrial energy, financial. See where I'm going here with this? Last 3 months, pretty clear. I mean, you've got a few discretionary in here, but look what they are: cruise line, apparel retail, broadline retail, brick and mortar broadline retail, cruise line, another brick and mortar retail. There are certain themes that have been playing out over the last 3 months. Now what I'm going to do is I'm going to show you what happened yesterday. So the worst performers: communication services, healthcare, communication services, discretionary, healthcare, technology, communication services. See where I'm going with this? All the stocks that have been leading last 3 months were losing yesterday. And if we flip it, got a discretionary in there, but again, it's Macy's. So it's a group that was performing very poorly. Financial, industrial, discretionary, but they're the cruise lines. Industrial, there you got airlines, another airline up here. Staples, this stock had been hammered, and now all of a sudden, last couple of days, the stock's up about 30%. More airlines. I mean, you kind of get what I'm saying here. And look at the S&P 500 here. I'm going to go in and just show you a breakdown of our week AD chart list. Now, these were stocks that were getting crushed and being sold off massively back in March and April. Look at the gains being made. There are only 270 stocks or something on this list. Look at all of them. And actually, I've got the numbers. Yesterday, on the week AD chart list, 87% of these stocks went up at least 3%. 74% went up at least 5%. That is amazing. That was the rotation that took place yesterday. A lot of these stocks breaking out above recent highs. A lot of these stocks heavily shorted. So we're probably going to see that continue. And then at the bottom, there were hardly any of these stocks losing ground. So all these stocks that were being so heavily sold off back in March and April, you hardly saw any of them selling off yesterday. I mean, 3 stocks lost more than 3%. In the past, we would see, the market, going up, and we'd see half of these shares or half of these stocks on this list going down 3% or more. So recognize what's taking place in the market right now. Adjust. If you're a very short-term trader, you might adjust to it in the very near term. And wait until you see these reversals or the money start rotating back and forth. It might be frustrating because I can't tell you if this is going to go on for 2 days or 7 days. If it goes on for 7 days, you're going to have a chance to make a lot of money in this area of the market, in this chart list for the next, week or so. If it happens for a day or two, you're going to get whipsawed. The one thing I would suggest, if you're not sure strong or weak AD chart list, stick with the strong earnings. This is our staple. I was looking at this, and yeah, we had some losers, but we also had a lot of winners on the strong earnings chart list. It was much better than the strong AD chart list. When you think about it, the stock market's going up or if it goes up, it's going to go up for one of 2 reasons or both reasons. One, it's going to be the Fed and the stimulus packages and so forth. You don't want to fight the Fed. The Fed's been, is a market friend. So you don't want to fight the Fed. You can sit back and say, well, the market's being manipulated by the Fed. Well, if the market's going higher, are you going to, stand in front of that freight train? Is it going to be a principle that, hey, the Fed shouldn't be doing this, so I'm going to take one for the team? That can get expensive. So that's step one. The other step here are earnings. Earnings are going to be improving off of this quarter. The second quarter is not going to be good. A lot of companies are not going to do well in the second quarter. The market already knows that. The reason the market's going up is because the market is looking at the third and fourth quarter and next year, and it's looking at these ridiculously low interest rates. And the market is saying, wow, these earnings are cheap. A lot of folks are saying, well, the S&P PE ratio is, too high relative. It's hogwash. Stock market is looking at these rates of earnings growth going forward, discounted back at historically low interest rates. Hey, I could be wrong, but I'm not going to be not confident. I am confident in what I think about the market, and I believe we're going higher. I think we are in a secular bull market, and I think most people have no idea how much higher we're going to go over the next 10 years. Just my opinion. All right, well, we're already 30 minutes in. I didn't even go through earnings. I will just tell you that there are a couple of companies that came out with earnings last night and this morning. One disappointment was Keysight Technology. You can see the stock gapping down. They missed by a wide margin on their revenues. Earnings per share, 78 cents versus $1 expected. So I'm not surprised to see the gap down. I think it actually will represent an opportunity in the stock. I just like the area it's in. I think the stock is still fine. It's not one of the best stocks in this group. And I think when you look at the relative strength, I think that kind of bears me out here. You can see relative to its peers, it's been going down. But I like the fact it's in technology. I think maybe in the short term, we could see a pullback into the low 90s. I think that would be a great opportunity if we get down there, though. One company that came in, beat top line, beat bottom line, is Hyco Corp. And Hyco Corp got a big gap up, pulling back now. It is one of the best performers in the aerospace group. So if aerospace continues to come back, I would actually look at this as a stock that I wouldn't be surprised to see a big reversal and take out that open later today and move higher. So I think after gapping up and pulling back, could be an opportunity. I'd watch a couple areas, gap support around 100, and then that rising 20-day moving average. If it continues to sell off, I think those two areas would be very good areas to take a look at. Let's see. How about VIPS? This is in broadline retail. They came out. They beat 20 cents versus 9 cents. This was a company that was doing really well relative to the broadline retailers, held this support area and is starting to turn back up again. I just think it's been consolidating. It did very well during the pandemic. I think it's consolidating. I'd watch 14 to the downside, but I think it's got a shot here to run back toward 19. All right, let's go ahead and wrap up with 3 you must see. These are 3 healthcare stocks that I really like, and I think that these companies, if they continue to sell off short term, will present some nice opportunities. In the healthcare providers group, Centene. And what I would be looking for here, the stock came out, had a pretty good report, was up near $75. Now it's at 64, so it's gone on, it's on sale now. But it's had a lot of support down around the 64 area, and that's about where we broke out. So I would maybe look for, or at least be thinking about, an intraday move that goes down to the 50-day, maybe even in below, and then reverses back up. So if I see a long tail to the downside and I get back, stock gets back to 64, 64 and a quarter, that would be an indication to me that maybe market makers have filled their inventory and that maybe they're ready to see the stock move back up towards 75. So this is one I'd watch. Second one would be Johnson & Johnson. Again, the stock down, not surprised. I think we're going to see more of what we saw yesterday. But I think as it moves down, I think you've got gap support all the way down just below 140, the 50-day moving average at 141, this breakout area around 143. So I just think as we get into the low 140s, I think Johnson & Johnson, especially since it was at 155 a month ago, I think this consolidation is presenting an opportunity here. And my final stock of the 3 you must see is Thermo Fisher. TMO, just like I expected, we're seeing weakness here again today. Stock was over 350 just a week and a half ago. Now it's below 330. I think we could make a move back down toward this 315, 320 area. And if we get down there, test that 50-day moving average, especially with like a reversing candle, a hammer, something like that. That's what I would be looking for. All right, that is it for today. Give you a quick update on the market, see what we've got. We got the Dow up 327 points, S&P up 25. Just like yesterday, look at what's going on. Dow leading, S&P lagging a bit, NASDAQ lagging a lot, small cap and mid cap leading. So we're going to see, at least to start the day, some of the same things we've been seeing. Look at the S&P leaderboard. Airline, apparel retailer, cruise line, airline. Lots of shorts getting squeezed in this move to the upside. That's another thing. You may want to check out the short squeeze chart list that we have at Earnings Beats. Those of you that are members, those of you that aren't members, you might want to sign up just for that, to get access to that short squeeze chart list, because a lot of those companies, I do think we're going to see some big rallies in. All right, everybody have a great day, and be back later this morning with my daily market report for Earnings Beats members. Everybody else, see you tomorrow over at Stock Charts. Take care, everybody. Happy trading.